Are you fed up with the same old talk about dividend ETFs? Well, hold on to your hats because I'm going to teach you 3 amazing ETFs that you must watch out for. These are the hidden gems of the ETF world, better than the S&P 500. Well, let's find out. Hey, welcome to another thrilling episode on this channel. In today's video, we'll be talking about 3 high-quality dividend exchange-traded funds, ETFs, that can help you take your investment portfolio to greater heights. We'll look into their strategies, compare different performances, and even determine possible returns from $100,000 investments in each. And guess what? One of these ETFs can transform your $100,000 investment into a colossal $20 million cash flow. There is more to come, so you'll also discover how these ETFs can be combined to minimize risk while still yielding substantial annual dividends and capital appreciation. All right, so if you're ready to discover the hidden gems of the ETF world and take your dividend investing game to the next level, hit that button and let's get started. So hold on for a minute. Before we get into this, the ins and outs of these 3 awesome dividend ETFs, okay? Let's take a moment to discuss the criteria used to select them. When it comes to choosing exchange-traded funds or ETFs for a great investment portfolio, there are a few non-negotiable rules. Our financial goals must match the combination we have chosen, whether focusing on generating income, capital appreciation, or both. In this way, it should be our money working hard for us, not vice versa. The key to reducing risk while maximizing returns is diversification. Hence, I went for ETFs with mixed investments as opposed to concentrating our wealth in one place, because variety is not only the spice of life, but also the secret of successful investing. Hey, when it comes to investment, nobody likes paying more than necessary. As such, these ETFs are low-cost ETFs so that we can keep much of our earnings with us. For example, every cent has its importance in wealth building. Investment demands stability. In this video, the past performance of these ETFs is going to be examined to ensure that they have a proven track record in terms of making money. You want to invest in funds that have survived the sea waves and emerged victorious, not those that make us seasick, right? Now let's get into the important part of it. Here are 3 dividend ETFs that are classified as world-class and will help you reach another galaxy with your portfolio. First up today is the Schwab U.S. Dividend Equity ETF, known as SCHD. Launched back in 2011, SCHD is not your average ETF. It's a passively managed powerhouse designed to give investors a slice of the high-quality dividend-paying stocks in the U.S. market. Now, this heavyweight has $52 billion in its kitty, and it is fully focused on the large cap value segment of the U.S. equity market. However, there is even more that makes this exciting. Despite having a humongous size and impressive results, SCHD maintains an incredibly low expense ratio of only 0.06%. Yep, folks, then you're going to like this exchange-traded fund if you're an investor who wants to save money but still get good income and grow over time. Therefore, an inexpensive lineup of top-notch stocks will not break the bank, so let's jump into this world with SCHD, which will make your investment dreams come true. Let's take a peek behind the curtain and uncover the magic of SCHD's stock selection process. This ETF doesn't play around when it comes to choosing its holdings. It follows a rigorous set of criteria to handpick financially robust companies with a stellar track record of dividend payments. SCHD only considers companies that have been consistently paying dividends for a minimum of 10 consecutive years. Talk about commitment. Companies must have a minimum float-adjusted market cap of $500 million to cut. Size does really matter in this case. To ensure liquidity, a minimum 3-month average daily trading volume of $2 million is required. Once qualified stocks are further ranked based on their dividend yield, 5-year dividend growth rate, financial health, and return on equity. This comprehensive evaluation process ensures that SCHD's holdings includes companies with strong financial fundamentals and a consistent increase in shareholder value through consistent dividend payouts. In the coming chapters, we're going to dive deep into the potential returns of a $100,000 investment in each of these amazing ETFs. But wait, there's more. There's a special surprise in store for you. One of these ETFs has the potential to turn your $100,000 into a staggering $20 million portfolio. So if you're ready to discover the ETF that could potentially make your retirement dreams a reality, keep watching. Don't forget to hit that like button, subscribe to our channel, and share this video with your friends and family. Back to SCHD. Now, this ETF portfolio consists of 102 holdings, with the top 10 holdings making up approximately 41.84% of the fund. These holdings include well-known names such as AbbVie, Chevron, PepsiCo, Pfizer, Coca-Cola, Verizon, and Texas Instruments, among others. These companies are industry giants renowned for their stability, profitability, and ability to generate steady cash flow, making them reliable sources of dividend income for investors. Let us now take a look at what killed SCHD last year. Yes, even SCHD can face challenges. Why is this so important? Well, people may become too impulsive due to the recent occurrences or focus excessively on losses rather than gains. By recognizing these biases, one can still make prudent decisions without losing sight of its objectives. Still a good choice for long-term investors despite recent setbacks. It has other advantages that are relevant to the question of whether it is worth investing $100,000 in the long term. Before anything else, let's crunch the numbers with respect to this stock. Now, the ETF has an annual yield of 3.38% and an average growth rate of dividends for the past 10 years between 10 and 20%, which is remarkable. And over the last decade, its share price has gone up by approximately 8%. From these metrics, Phil will earn $111,380 in 1 year if he invests $100,000 into this ETF. But after 10 years, he'll have $306,484 from that investment, mostly because of dividends, which tripled during the time frame, according to calculations using those figures alone. However, it is the long-term dividend yields that truly shine for SCHD. In 20 years, John's investment will grow to $1,050,609, and if he extends it to 30 years, his initial investment may increase to $4,170,308. Remarkably, he would receive a huge $276,825 per year as dividends, while in a rough estimation, monthly income will be equal to $23,069. So overall, this ETF might add $4,070,308 to his initial investment, with capital appreciation contributing ultimately $2,251,669 and reinvested dividends adding up to an amazing $1,818,369, which demonstrates the strength of compound interest models surrounding dividend reinvestment. Next up, we have the Invesco QQQ Trust with the ticker symbol QQQ. This exchange-traded fund ETF offers investors exposure to a diversified portfolio of stocks like SCHD. This ETF also uses a passive management approach. Unlike active funds whose financial experts pick investments on their behalf, QQQ aims to copy its underlying index known as NASDAQ 100. This strategy helps maintain charges low, around 0.2%, which is quite high when compared with SCHD, but once you see the historical returns and the yield I'll show you later, it all comes together. Now, the top 100 companies listed on the NASDAQ Stock Exchange that are mainly in technology and growth sectors form the NASDAQ 100 Index. These businesses are some of the most innovative and dynamic in the market, including big names such as Apple, Microsoft, Amazon, and Alphabet. Some of the highest performing stocks in the semiconductors, healthcare, and software sectors make up part of QQQ's portfolio that allows investors to tap into diverse sources of growth. Now, when it comes to historic performance, Q has a remarkable track record that speaks for itself. Over the past 3 years, QQQ has delivered an average annual return of 10%, an impressive 22.4% over the last 5 years, and a remarkable 17% return over the past decade. This consistent performance has allowed QQQ to outpace the broader market, including the S&P 500 index. QQQ's consistent performance has solidified its position as one of the premier ETFs in the market. With a staggering $259 billion in assets under management, QQQ's success is undeniable. However, as investors, we must consider the valuation of QQQ, especially in the current market environment. Some of its holdings are trading at high multiples of earnings and book value, raising concerns about potential overvaluation. Buying QQQ at peak prices could lead to prolonged periods of waiting for returns reminiscent of historical market downturns. Therefore, cautious consideration of entry points is advised, balancing potential returns with valuation risks. Now, despite valuation concerns, Wall Street analysts maintain a generally positive outlook on QQQ, with a majority rating it as a moderate buy. Analysts foresee potential upside for the QQQ stock price, projecting an approximately 11.89% increase from current levels. This sentiment reflects confidence in QQQ's underlying assets and their long-term growth prospects, despite short-term market fluctuations. So Wall Street analysts think this is a good ETF, and history suggests the same, but what does the future look like? Let's find out. QQQ has a current dividend yield of 0.55%, not the highest, but it has a good dividend growth rate of 9.93%. This ETF is about capital appreciation, which can be seen from its average share price growth over the years of about 17.70%. Based on these metrics for QQQ, Phil's investment after the first year is expected to reach $118,250. After a decade, the investment is set to more than quadruple to $527,504. After 20 years, Phil's investment is forecasted to reach $2,731,723. Give it 10 more years, and in 30 years, his initial investment has the potential to grow to an impressive $14,030,517, paying $6,277 in annual dividends. In total, this ETF has the potential to add $13,930,517 to its initial investment, with $13,858,290 attributed to the growth of QQQ stock, while $72,227 came from dividends. These returns are extremely good, but can our first-ranked ETF do even better than that? Let's find out. Vanguard Information Technology ETF, known by its ticker symbol VGT, is a force to be reckoned with in the world of growth-focused ETFs. Managed by the renowned Vanguard, this ETF is all about capital appreciation, setting it apart from our first ETF, SCHD, which is dividend-focused, and QQQ, which aims to track and outperform the index. The only mission of VGT is to make more money for your investment. It manages to do this by investing solely in technology. For instance, the ETF removes these companies from its holdings. Amazon is treated as a retail company. Google or Meta are shown as communication companies. With such a focus, VGT ensures that investors are exposed to the heart of technology, focusing on innovation and growth. Even though this investment ratio is double what the average Vanguard ETF charges, 0.10% versus 0.05%, it remains far below that for comparable technological funds. In contrast with other broad-based ETFs like Invesco QQQ, where non-tech firms are incorporated, VGT stays locked into its sectoral mandate. By exclusively targeting the tech sector, VGT is positioned attractively towards those interested in the long-term growth of technology firms. The big question now is, can VGT outperform the QQQ estimate? Well, let's see. VGT has a current dividend yield of 0.7%, not the highest, but it does have one of the strongest dividend growth rates of 14.36%, and an even better average share price appreciation of 19.13%. In the first year, Phil's $100,000 investment in VGT is projected to reach $119,830 after 10 years. The same investment is projected to multiply sixfold to $603,732. After 20 years, his investment is forecasted to be $3,578,687. Pushing even further to 30 years, his initial investment has the potential to skyrocket to a remarkable $20,975,390. Additionally, he would receive $29,827 in dividends annually, translating to about $2,486 monthly. In total, this ETF has the potential to add $20,875,390 to his initial investment, with $20,632,836 coming from the growth of VGT, while $242,527 came from the dividends. Well, you're in for a surprise, dear friends, since I'm going to introduce you to the trio of shares that can transform your investment strategies the way all three ETFs we've discussed so far do. It's an excellent opportunity to invest in these ETFs, but just like any other kind of investment, there are risks involved. Diversification is essential to minimize these risks and maximize the growth potential. This variety enables you to distribute the resources across various styles. Thus, it means that your economic prospects could not be solely pinned on whether a particular firm or sector becomes successful. QQQ can deliver substantial capital appreciation. VGT keeps up the contemporary technological advancements. SCHD balances income generation and growth with the possibility of being grounded toward stability. Investing equal amounts into each of these ETFs allows you to compute key ratios that help assess how well your portfolio has performed. Simply add up respective yield percentages and then divide by 3. This will give you results ranging from average dividend yield to dividend growth and annual earnings per share growth. For our trio of ETFs, we have an average current dividend yield of 1.54%, a robust dividend growth of 11.72%, and an impressive average annual growth of 14.94%. Let's put this into perspective for Phil. After 1 year, $116,480. After 10 years, $451,710, quadrupling his investment. After 20 years, $1,975,972. After 30 years, $8,445,497, paying an annual dividend of $43,572, or approximately $3,631 monthly. In total, this portfolio is projected to significantly grow Phil's investments by $8,345,497, with $7,951,990 from the rise in portfolio value and $393,507 from dividends. And there you have it, folks, a trio of ETFs that could potentially transform your investment game. From the dividend-focused SCHD to the index-tracking QQQ and the tech titan VGT, each ETF brings its unique strengths to the table. What's your most preferred ETF out of the 3 listed in this video? Love to hear from you. Drop your answer in the comment section below. Hey, if you enjoyed this video, be sure to hit that subscribe button and turn on notifications so you never miss an upload.